Good day, everyone. Today we will be looking at Module 4 of the analysis of the Nigerian tax bill. And under this Module 4, we will be looking at Chapter 4 of the Nigerian Tax Bill 2024. Now, Chapter 4 of the Nigerian Tax Bill 2024 addresses one of the most pressing issues for taxpayers with cross-border income, which is double taxation. Now, double taxation occurs when the same income or profit is taxed by both Nigeria and another jurisdiction, leading to an excessive tax burden. So, to mitigate this, Chapter 4 introduces mechanism to provide relief for Nigerian residents earning foreign sourced income, ensuring fairness and compliance with international tax practices. So, this chapter establishes two primary forms of relief. Now, the first one is unilateral relief for cases where Nigeria does not have a double taxation agreement with the foreign jurisdiction. Now, for the double tax agreement based relief, these are for cases where treaty exists between Nigeria and the other jurisdiction. These provisions ensure that taxpayers are not disadvantaged in international business and trade while maintaining Nigeria's fiscal responsibility. So we'll be looking at unilateral relief for double taxation, which is section 119, and the scope of the unilateral relief. This actually apply when a Nigerian resident earns income or profit that is subject to tax both in Nigeria and a foreign jurisdiction. And in this case, Nigeria does not have a tax treaty, DTA, double tax treaty, with the jurisdiction where the foreign tax is paid. So now the condition for relief is that to qualify for unilateral relief, the foreign sourced income must be repatriated to Nigeria through a government approved channel, ensuring transparency and accountability. Now, proper documentation must be provided to validate the foreign tax payment. Mechanism of relief calculation too is also very important. The tax relief is determined as the lower of, so this is the mechanism of relief calculation. The tax relief is determined as the lower of the Nigerian tax on the foreign income calculated by prorating Nigerian tax base on the ratio of foreign income to total income. So the actual tax paid in the foreign jurisdiction would be this. Now let's look at an example, a scenario. Let's say a Nigerian resident earns 50,000 US dollars in a foreign country without a double tax agreement. Now, for example, the foreign country taxes this income at 20%, resulting in a $10,000 tax payment. That means, if you remember, the Nigerian resident earns about $50,000. Now, this foreign company or this foreign country already taxed the income at 20%. So the Nigerian resident is already taxed $10,000 tax payment. Now, Nigeria's prorated tax on this foreign income is calculated as, let's say, $8,000. So definitely, the resident will receive a tax credit of $8,000 in Nigeria, as this is the lower of the two amounts. This is the lower of the two amounts. So let me just repeat the scenario for a clearer understanding. I've used a simple scenario to say that a Nigerian resident, let's say for example, a Nigerian resident in Ghana, or a Nigerian resident, rather earns $50,000, in Ghana. So this $50,000 now, is, for example, a foreign country. I'm using Ghana as an example where, let's say, we do not have a double tax treaty. assuming that we have a double tax treaty. So using that as an example, a Nigerian resident earns $50,000, in Ghana. Now Ghana has already taxed the Nigerian resident income at 20%. That means the Nigerian resident has paid about $10,000 in tax payments to Ghana. So let's say the Nigerian tax revenue or the Nigerian Revenue Service, for example, now prorated this tax on his foreign income. So that's the Nigerian's prorated tax on his foreign income is calculated at $8,000 now. So the resident will definitely receive, that's the Nigerian resident will receive a tax credit of $8,000 in Nigeria, as this is the lower of the two amounts. So that is what the unilateral relief is trying to explain. Now, for double taxation relief. A double taxation agreement is a treaty between Nigeria and another jurisdiction that ensures relief from double taxation for individuals and businesses earning cross-border income. So for a double taxation agreement to be effective, it must be ratified by the National Assembly of Nigeria. The treaty provisions override conflicting confidentiality or domestic tax laws in Nigeria. So for it to be effective, it must be ratified by the National Assembly, and the treaty provisions also override conflicting confidentiality or domestic tax laws in Nigeria. Now, key provision of a particular of a DTA now of a double tax agreement. One, information disclosure. Taxpayers must provide details about foreign income and taxes paid, even if confidentiality laws are in place. This ensures compliance and transparency. So these are the key provisions under a double tax treaty agreement: information disclosure. Then, secondly, anti-treaty abuse measures. Relief is granted only to taxpayers who are residents of a treaty partner and the beneficial owners of the income, preventing treaty shopping and abuse. Now, for the relief method, which is under section 120 to 121, double taxation agreement based relief is provided in the form of a tax credit determined as the lower of the Nigerian tax on the foreign income, the foreign tax paid in the treaty partner jurisdiction. Now, let's look at the treatment of foreign tax. Now, foreign tax payment cannot be deducted again in Nigeria when computing Nigerian tax on the same income. This avoids double benefit and ensures accurate tax reporting. So the timeline for claims to tax credit claims must be submitted within 2 years after the relevant tax year. Adjustments due to foreign tax reassessment must be claimed within 2 years of the final determination of adjustment. So let's look at an example now. A Nigerian business earned $100,000 in a treaty partner jurisdiction. Now, the treaty partner taxes this income at, let's say, 15%, resulting in $15,000 tax payment Now, Nigerian tax on this foreign income is calculated at, let's say, $20,000. The business receives a $15,000 tax credit in Nigeria, equivalent to the tax paid in the treaty partner jurisdiction. Now, the mechanism for calculating the tax relief will be allocation of Nigerian tax on the foreign income is calculated as a proportion of Nigerian tax base on the foreign taxable income. So the foreign taxable income slash the total income. This ensures that the Nigerian tax on foreign income is effectively prorated. Now, there's a tax credit limit. Relief is limited to prevent excessive credits. Only the portion of Nigerian tax attributable to foreign income can be credited, even if the foreign tax paid is higher. So foreign income and exemption rules. is also applicable. So where foreign income is exempt, from tax in Nigeria under a double tax treaty, it is still considered in determining the overall tax rate applicable to the remaining Nigerian income. Now, to clarify its provisions, Chapter 4 defines critical terms. Foreign tax, tax paid to a foreign jurisdiction with or without a double tax agreement. And then Nigerian tax is taxes imposed under the Nigerian Tax Bill 2024. A treaty partner means a country with which Nigeria has an effective or an active double tax agreement. Foreign income slash profit versus total income. Total income for a Nigerian resident include both the Nigerian and foreign source income. Let us now look at the key implication of Chapter 4. Key implication of Chapter 4. Okay, we've looked at the definition of terms, the foreign tax, the Nigerian tax, treaty partner, foreign income slash profit versus total income, and all those things. We've also looked at the mechanism of calculating tax relief. Then we've also looked at the tax credit limitation. We talk about relief is limited to prevent excessive credit, ensuring that only up to the amount of Nigerian tax attributable to foreign income can be credited. We've also looked at the taxable income and exemption. So foreign income exempt from tax in Nigeria as per the double tax agreement is used to determine tax rates on the remaining Nigerian income. So the implication of this, after having looked at the definition, foreign tax, Nigerian tax, treaty partner, foreign income, and all that. So this chapter implication is that one, it simplified tax obligations for Nigerian residents with foreign income. So by reducing or eliminating double taxation, Chapter 4 lowers the overall burden or the overall tax burden for residents with foreign income, encouraging compliance and cross-border economic activity. Number two, anti-avoidance provision. This chapter includes safeguards against treaty abuse, such as the requirement for treaty partners resident to be the actual beneficial owners of the income. So this ensures that tax relief is not misused. Compliance requirement: taxpayers must bring foreign source income into Nigeria through approved channels to qualify for relief. And this provision reinforces transparency and accountability in reporting foreign earnings. Administrative timelines establishes a 2-year time framework for tax credit claims, encourages prompt reporting, and minimizes delays in compliance. In conclusion, Chapter 4 of the Nigerian Tax Bill 2024 represents a strategic and well-structured approach to preventing double taxation for Nigerian residents with cross-border income by offering relief through unilateral measures or double taxation agreements. The chapter ensures fairness, reduces tax burden, and aligns Nigerian tax framework with international best practices. At the same time, it incorporates robust anti-abuse measures and detailed administrative processes to promote compliance, transparency, and fairness in the taxation of foreign income. So for taxpayers engaged in international businesses or investment, this chapter is instrumental in creating a balanced and equitable tax environment that foster growth while upholding Nigeria's fiscal interest. So let's look at the call to action for taxpayers. The taxpayers need to review their eligibility for tax relief under these provisions, ensure all foreign income is properly documented and brought into Nigeria through approved channels, and they should also consult with their tax professionals to optimize their tax position and take full advantage of the relief. Through Chapter 4, the Nigerian Tax Bill 2024 ensures that Nigeria remains a competitive and compliant player in the global economy. Thank you for listening, and see you in the next module. Thank you.